You found the perfect investment property. You go to your local bank and they want to help you out. They can actually do a DSCR loan for you. But your loan officer immediately asks you for 5 different pieces of information: your tax returns, your bank statements, your W-2, your pay stubs for the last 60 days, and the actual signed lease agreement for the property. And you're wondering, why do I have to have all this information to get a DSCR loan on an investment property? Hey guys, Ryan Dement. Hope you guys are doing well. It's Labor Day. I thought I would share a video today on DSCR loans, a little bit different than what we typically do on the actual podcast. When you're watching or listening to this episode, it'll come out on Wednesday, September 3rd. If you guys like what I'm doing, please subscribe and share and comment. I'm trying to put a community together and I need your help to get subscribers, comments, and of course, shares. So let's get into it. You typically work with a local bank or a local credit union, and you're going to them because you have a built-in relationship with them and you found a perfect investment property. You want to get a DSCR loan, and they ask you for 5 pieces of your personal information, and you're left wondering, scratching your head and asking, why? The property is an investment property. Why do you need all my information? Let's start with number 1. A local bank or a credit union, they're not going to underwrite a true DSCR loan, which is a non-QM, which is non-qualified mortgage. They're going to qualify it based upon your income, your debt to income ratio, all of your assets, because that is the simplest way that they can actually do it to make sure they can check a box and lend on the property, which means this is going to impact your personal credit. It's going to go on your credit report. And oh, by the way, it's going to affect your debt to income ratio. So why do I bring this up? There's several things. You're probably going to your local bank or your credit unions because you're going to get a potential better rate. That is true, 100%. There are times where a local bank or a credit union can get you a better rate. And the reason why is they're writing the loan as a conventional one. They're underwriting it with your personal information, not off of the actual asset. If you're looking to scale and grow your investment portfolio, you're going to max out at 2 or 3 of these loans on your personal credit unless you're making millions of dollars, because your debt to income is going to go through the roof because you're going to have to service the debt on your personal credit bureau. You're probably asking now, Ryan, what's the difference? When you come to somebody like myself that is also a lender/broker, we don't work with local banks or credit unions. We work with true DSCR non-QM lenders. They are not basing their underwriting criteria off of your personal information, other than one aspect. There's only one aspect of this game that you have to play. It's your credit score. That is all they're going to look at. Higher the credit score, the better rate you're going to get. So once you get that taken care of and you've got yourself a solid credit score, the lenders that we work with, they're basing it all solely off of the asset. And how are they going to determine that? 1, they're going to do an appraisal. Make sure that the purchase amount that you're paying or you're wanting to pay for is going to make sense from the appraisal. The second thing they're going to look at is they're going to do a schedule of rents, whether it's from the local market or what you actually have today in active rents with a lease agreement. They'll look at both. Some lenders will take the lesser of the two. Some lenders will let you take with the actual lease in place. So you need to ask that question when you speak to your loan officer/broker, that you know exactly what schedule of rents that this lender will work with. You can close these loans in an LLC. If you go to your local bank or your local credit union, you cannot close it in an LLC. They will only allow you to close it in your personal name because they have to be able to put it on your credit. They are underwriting via conventional, they're using underwriting criteria from conventional loans, which is 100% meant for residential properties, for owner-occupied properties. So they're just taking it and moving it over and saying, okay, we're going to use these underwriting criteria to make a investment property work within their box. And if you don't check the box or fit in that box for them, you're done. On the other side, a DSCR lender is not looking for you to check a box or fit in the box other than your credit score. After that, it's all based upon the actual property and the asset. Of course, you have to come to the table with anywhere between 10 and 20% down plus closing costs. It's the exact same thing on the other side of the equation when you do conventional lending. They will still want 20% down on that deal. Now, when you actually get into the underwriting process, and I'm going to start with the conventional / local bank, local credit union. Like I said earlier, they're going to want your last 2 months of pay stubs, the last 2 months of your bank statements, your W-2, the last 2 years of your tax returns. They want to see all that information so they can build a picture on your credit, not on the actual asset. Do you offer DSCR loans based upon the asset, not actually off of my credit and my score? Because ultimately, it's going to ruin your credit over a period of time. Like I said earlier, you could have 2 or 3 on your credit and it'll max out your DTI. So let's say you don't currently own your primary residence, and at some point after getting 3 or 4 rentals under your belt, got some money saved away, you want to go buy a house. Guess what? You've got these other properties on your credit report, and lo and behold, you're going to go out and try to buy a house. They're going to add this new mortgage payment into your debt to income ratio, and you're not going to qualify. So you're thrown out of the actual race to get your own primary residence. So what can you do? Several options. One, don't start with a local credit union or a bank to get a DSCR loan when it's actually going to be a conventional loan and it's going to go on your credit. Depending on when you originated these loans, there could be a potential of prepayment penalty. So take a look at that. There typically shouldn't be, but if there are, it's usually anywhere between a year and 5 years. So ask that and figure out if there's a prepayment penalty. If there is a prepayment penalty, it's usually tiered. So let's say it's a 3-year prepayment penalty. So in the first year, it would be a 3%. The second year would be 2% and 1% of the outstanding loan balance. Where I'm going with this is you need to refinance it out. You need to refinance that property out of your personal name and get it into your LLC's name. Now, are you going to potentially lose your lower rate? Yes. So before you do that, you need to do the numbers to ensure that your property is going to continue to cash flow. If you go from let's say a 4% interest rate up to a 6% interest rate, are you going to cash flow? A DSCR ratio of 1.0 and less is garbage. You're losing money. At 1.0, it's only covering your PITI, principal, interest, taxes, and insurance. It doesn't include any type of maintenance, any type of reserves. You also have to pay your property management company if that's what you're doing. So you're losing money. You need to be somewhere, and this is where you build your math and go through every single expense line to make sure you're not missing anything. You need to be at a DSCR ratio of 1.25 or higher. If you get to 1.35, 1.45, you're really giving yourself some cushion, God forbid, if something happens, especially if you have to worry about any type of items going out like your HVAC or water issues or electrical, especially if these are older homes and the life on these items are running thin, you need to be putting reserves away to make that happen. Otherwise, you're coming out of your own pocket or slapping it in on a credit card, which is not cool at all. So guys, please do the math. Make sure when you get into a DSCR loan, your ratio is 1.25 or higher to make sure that you've got some reserves and some cushion. Don't let somebody sucker you into a 1.0 or less, because you're truly losing money. The next thing, guys, is make sure your LLC documents, when you're working with this loan broker or loan officer, they're correct. Sit down with a CPA or somebody that you trust that can draw up your operating agreement, your articles of organization. Make sure you get your EIN number. Make sure you've established your bank account. All can be done in a very short period of time, and lenders really don't care if it's brand new, as long as you can show them that everything's set up properly. Now, let me give you a little bit of a tidbit here. On multi-member LLCs, make sure you define ownership percentage and who's going to be the CEO or the president or the chief operating officer, whatever the case is, because ultimately that is going to allow you to define who's going to personally guarantee the loan. Yes, I just said that. Personally guarantee the loan. So when you buy it in your LLC's name, at least one person that has 20% or more equity or ownership in your LLC has to personally guarantee it. It does not go on your credit report. God forbid, if something happens to the property and you stop making payments, they can report it to your personal credit bureau as late, but they also can come after you for either the deficiency balance or the past due payments. You have to make sure that you understand what you're signing. The third thing, and I'll wrap this up, know what you're signing. Read the actual closing documents. Read the loan estimate. Read the closing disclosure. Understand the terms of the loan, what you're signing up for. Make sure that everything is correct. If you have any questions, comments, concerns, bring those up to the lender or to your loan officer / broker before you sign on the dotted line. Because once you sign on the dotted line, you're on the hook. It's all downhill from there. Ensure that you understand what the terms of your loan are going to be. Do you have a prepayment penalty? God forbid, please don't tell me you're doing interest only. Make sure you're doing a full principal, interest, taxes, insurance payment. Make sure you understand when the payment is due on a monthly basis. Does the lender require you to have auto debit drafted every single month, or can you pay it on your own? And lastly, understand the terms of the loan. Is it a 20 years? Is it a 25 years? Is it a 30-year loan? So you know exactly what you're getting into. One last piece, guys, and I'm going to wrap this up. I'm not saying not go to a local bank or credit union. I'm just telling you, if you're going to scale and grow your business, you can't do it by putting it on your personal back or doing it on your own. Been there, done that. Doesn't work. You literally have to scale through DSCR loans. All right, guys. Hope you guys have a great week. Stay healthy, stay safe. I'll see you guys on the other side. If you have questions, comments, please leave them. Like and subscribe. Love to hear your feedback.